A superinvestor is an individual who has consistently achieved exceptional investment returns over a long period of time, often outperforming the broader market and their peers. Meet Deb Kantasaria, owner and manager of Valley Forge Capital Management. Valley Forge is a hedge fund investment firm founded in 2007 that has an interesting take and investment style. Their mission is simple and straight to the point, and that is to significantly grow the buying power of our investors over a multi-year time frame. We seek to outperform relevant equity benchmarks over the long term using a bottom-up fundamental approach executed in a disciplined and consistent manner. Valley Forge Capital divides their investment criteria into 4 points. Number 1, bottom-up fundamental approach, a rigorous strategy to find high-quality businesses with a strong organic growth, predictable earnings, capital efficiency, and prudent management. Number 2, monopolistic characteristics. They look to buy companies with a leading industry position that can thrive in a variety of economic conditions. This approach reduces the need to market time around macroeconomic factors, which are difficult to predict in the short term. Number 3, these companies must be compounding machines. Companies that can grow their intrinsic value over a multi-year period organically. And number 4, analyzes the future of the company, running a discounted cash flow analysis that could assist the firm to predict earnings beyond the current values in order to focus on the stability of the long-term health of the business. These are the 4 criteria the firm consistently follows in order to make great investments. But what about the portfolio construction? The firm believes that a concentrated portfolio of high conviction ideas is the only way to significantly outperform the benchmark over a long period of time. In order to reduce risk, they emphasizes business quality, seeking margin of safety, using minimal leverage, avoiding speculative securities, and maintaining a liquid portfolio. Now, you may be asking yourself, what does a concentrated portfolio of high quality businesses with monopolistic characteristics looks like? And here you have it, a portfolio value at $3.8 billion with just 8 holdings. Holdings that at a quick glance, you can recognize some of them and already know that they are high quality. We have Fair Isaac, MasterCard, S&P Global, Moody's, Intuit, Visa, Aspen Technology, and ASML. Their top 3 holdings take above 60% of the portfolio, but overall, this is a highly concentrated portfolio of high-quality businesses. I assume at Valley Forge, they have a great time analyzing these companies because it's not a lot of holdings, so they can fully focus on every single number and aspect of the business. Throughout the history of the firm, as mentioned in their thesis, they never add too many holdings. They always remain concentrated, but throughout time, they always have sold and bought new positions. Giving a quick look at the holdings they sold and my guess on why they are out. We got Autodesk, Amazon, Adobe. Starting with Autodesk, the company seemed to be having a bad time back in 2016, all the way to 2019, then recovered. I believe Valley Forge sold at a small profit. They started buying around 2019 and sold around 2023. Despite the company moving in the right direction, I believe one of the main criteria selling was due to the massive increase in stock-based compensation, which is the purple bar, and the decrease in free cash flow, which is the orange bar. High stock-based compensation works against investors because it dilutes your position, making it be worth less. For Amazon, he also sold at a profit, but this sale was a mistake in my opinion. Dev sold at the end of 2022, just before Amazon stopped increasing their capital expenditure and turned into a net positive cash flowing machine. Now, for Adobe, he bought in 2020 and sold in 2023. I don't see anything wrong with this company other than I don't think their moat is as strong as it used to be due to the new apps and AI chipping away their market share. Anyways, you did not click this video to see what Deb Kantasaria sold. Instead of going through each position and showing graph after graph, I made a table with all the fundamentals so we can visualize it in an easier way. Reviewing the holdings again, we have FICO, MasterCard, S&P Global, Moody's, Intuit, Visa, Aspen Technology, and ASML. With just the top 4 holdings, it takes over 60% of the portfolio, so this is super concentrated. Starting with the revenue, which is income generated from normal business operations, we have a variety of single digits and double-digit returns. Now we have the net income, which is the sales minus cost of goods sold, general expenses, taxes, and interest. This shows the profitability of a business. We have a similar scenario like the revenue, single digit and high double digit returns, except for Aspen Technology, which is in the negative. This is probably because the company has a huge increase in sales and marketing, so that it's eating their money. As we continue with the numbers, you might see that this company is not performing as intended. I think this is one that will be eliminated from the portfolio in the future, but the holding is so small that it's probably not doing any dent to the portfolio value overall. Now we have the adjusted free cash flow. Free cash flow is the money after paying all expenses. This money is used to pay dividends, invest in the growth of the company, or simply pay any long-term debt. Now, the adjusted version just takes out the stock-based compensation. And again, most of the businesses have double-digit free cash flow and only 2 in the single digits. To clarify, Moody's and Aspen are in the single digit of free cash flow, but on Moody's end, we are talking about billions of dollars in free cash flow. While for Aspen, we are talking in the millions. That's a huge difference. Now we have the free cash flow per share. This measures the company's financial flexibility. If a company increases cash flow and reduces shares outstanding, then the free cash flow per share will explode to the upside. In this case, I said all the companies are doing decent, but the ones with 15% or more are the ones standing out of the crowd in terms of quality. Now we have the return on capital employed. This is how much a business gets in return for every dollar invested. All companies are doing extremely well in this section except for you know who, which stands in the negative. The reason why S&P Global doesn't have a high ROCE in this case is due to an acquisition they made. If it wasn't for that, it would easily be a double-digit ROCE. Operating margin measures how much profit a company makes on a dollar of sale before any expenses. Again and again, we see double digits high operating margin except for one. And last, profit margin. After taking the expenses from the profit, this is the percentage that shows what the company keeps. Same as operating margin, we have super high double digits returns except for one. And this is it. A super concentrated portfolio that majority of the holdings are super high quality. Since inception, this portfolio has done pretty good with very minimal turnover, which means that Dev is a high quality buy and hold investor. He trusts his thesis so much that barely any selling happens within the portfolio. Now, 2 things I want to point out. Number 1, I don't know the thesis behind Aspen Technology. Fundamentally wise, it looks like a coin flip. But on the good side, this is just 1.66% of the portfolio. Number 2, the portfolio has overlapping risk. This is when you have too many companies within the same sector, Visa and MasterCard, FICO and Moody's. It is something to have into consideration, but again, this whole portfolio overall is built of high quality businesses. I do like this portfolio. I will do some cleaning and maybe expand a little bit more into other holdings and also reduce the allocations of the top 4 by investing money in other holdings. But so far, this is a great portfolio for my current favorite investor. That will be it for this video. Thanks for watching. Like and subscribe, and I'll see you in the next one.